Well, hello, this is Anthony Sakaro, founder and president of Providence Financial and Insurance Services, located right in the heart of the San Fernando Valley in Woodland Hills, California. And I'm also host of the Providence Financial Retirement Show, which airs every Saturday on KRLA AM 870 The Answer. And the purpose for this video today is to talk about market history, to talk about where we think the stock market is likely to go. And if you've listened to my radio show at any point in time, or if you've seen me on Fox Business or CNBC or one of the other major networks, then you know that I think the market has some problems ahead. And I want to take some time and talk about, why do I think that the market has some problems, and why does history think that the market has some problems? Now, let me ask you a question. Do you believe that, generally speaking, history tends to repeat itself more often than not? Well, I'll tell you what, if you're like most of my listeners, then I know you absolutely do. And yet the reality is Wall Street doesn't want you to think that. They want you to think that history repeats itself in every other area besides the stock market. But the fact is that's not true. You realize the stock market's been around over 200 years? A lot of people don't even realize that. And so we have 200 years of history. And if you study market history, then what you'll realize that there are predictable and repeatable trends. And the stock market is not just random like Wall Street wants you to believe. Now let me ask you, if you knew what these trends were, and you knew where we fell into a trend today, do you think it would help you make decisions about your money and your investments right now today? Of course it would. And that's why I want to take the next 5 or 10 minutes and share with you what those trends are to see if you can pick up where we might be going from here. So what I want to do is I want to talk about the trend that we're currently in, and that trend goes back to the year 2000. And then I want to go back in history 100 years and show you the bigger picture and how does our current trend fit into the bigger picture. I think you're going to find that super valuable. So let's start talking about the current trend that we're in. Well, right now, if you go back to the year 2000, you'll notice that from 2000 to now, February 2016, the market has done this. The market in 2000 reached an all-time high, never been there before. But from 2000 to 2002, the market had roughly a 50% crash. But from 2002 to 2007, the market came back and then some. But from 2007 to 2009, the market had roughly a 60% crash or thereabouts. And from 2009 to 2013, the market came back to where it had been 13 years earlier in the year 2000. And from 2013 to here we are in 2016, the market is up about 25%. Now, it had been up about 35%, but it's down about 10%, really just in the last few months. And so now we're up about 25%. But no matter how you slice it and dice it, we're still at all-time highs at this point, just off by the all-time high by about 10%. And the $64,000 question is, where do we go from here? And some people think that the worst is behind us, and the market's just going to keep growing. But most people think, no, not so fast. We probably have some problems ahead, and that means that we might have a correction, or we might even have worse than a correction. We might even have a major crash coming. And so the question for you is, what do you think is more likely? You think we're in permanent recovery mode at this point? Or do you think that we probably have some problems ahead, and really the market's just going to be stuck for a while? And as we go through the rest of market history, I think it will be clear as to probably which way the market's going to go at this point. But that's the question. Where do we go from here? Because if you know the answer to that question, then you have a good idea as to how to invest your money today. So let's talk about the 200 years of market history and how this fits in. Now, before we do that, do you know on average what the average rate of return of the stock market is? Well, most advisors and most everything you read out there is going to tell you about 10% a year. And that's actually very true. It's about 10% a year over the long run. But the problem is it's not the whole story. you know, averages by themselves can be very misleading, and unfortunately it is. It's not the whole story. I'll give you a silly example about how misleading averages can be. I can tell you that on average, my wife and I run about 10 miles a week. About 10 miles a week. But that's also not the whole story. The way that I get there is she actually runs about 20 miles a week, and I don't run at all. So isn't it a true statement that we run about 10 miles a week on average? Of course it is. But isn't it a much different picture when you understand how I got to that 10 mile per week average? Absolutely, it paints a much different picture. And that's the same thing with the stock market. When a stockbroker tells you, or one of these big Wall Street firms, you know, tells you that the stock market averages 10% a week, that sounds really good when you look at banks and bonds and other investments. But it's not the whole story. And when you understand the whole story, it paints a completely different picture. And my goal today is in the next few minutes, to share with you how they come up with that average. How does that average really work? And so the way I'm going to do that is I'm going to do that by drawing out a bear market column and a bull market column. And of course, a bear market's when the market goes down, right? And a bull market is when the market goes up. So bear market and bull market. And if we go back to 1899, what you're going to see is that from 1899 to 1922, we had a 23-year bear market. 23-year bear market. Now, a lot of times when I say that, people will say that they've never heard that before. And let me ask you, you know, when you read the Wall Street Journal or you watch us on Fox Business, do you ever hear that? And the answer is no. You know, well, then how do you know that I'm right? Well, really, it all depends on how you define a bear market. If we go back to the year 2000, the analyst is going to say that, guess what? Because the market started going down, we got into a bear market. But then the analyst says, you know, here, because we hit a bottom, the bear market's over, and now we're back into a bull market. But let me ask you, if your portfolio is down by 50% or more, does it feel like the bear market's over to you? Of course not. My clients tell me virtually every day that the bear market's not over to them until they get their money back and start making money. Do you agree with that? And if you're like most of the people I ask, you absolutely do. So, but that's not what the analyst says. The analyst says that this is a bear market, this is a bull market, this is a bear market, this is a bull market. But if the bears and the bulls are washing each other out, how much money are you making? Well, the answer is nada, zilch, nothing. You're not making anything over that time. So when I talk about a 23-year bear market, I'm not talking about 23 years of straight down. I'm talking about 23 years of ups and downs, but at the end of the day, zero return. Hopefully that makes sense. So 1899 to 1922, 23 years, zero return. But then in 1922, the market took off and started to do well, went strong for 7 years until 1929. Market went up about 400% during that time period. But in 1929, we know from our history books that something happened. The major crash, the Great Depression, started in 1929. Now, if you invested $1,000 at the peak of the market in 1929, well, you would have immediately lost money. But let's say you didn't panic, you didn't sell, you did what Wall Street wanted you to do. You just hung in there. Any idea how long it took you to get your $1,000 back and start making money again? Well, the answer is 25 years. 25 years. It took you until 1954, or 25 years, to get your money back and start making money again. Again, not 25 years of straight down, 25 years of ups and downs, but at the end of the day, no growth, no growth. 25 years. But then in 1954, the market started to do well again. This time went strong until 1966. It went strong for a dozen years, 1966. And in 1966, the Dow Jones hit a level that it had never hit before. And that level was 1,000. And right now today, February of 2016, the Dow Jones is hanging around the 16,300 level, somewhere in that range. Matter of fact, I think we're down a couple hundred points today, so maybe we're closer to 16,100. But the bottom line is for the first time in 1966, it hit 1,000. But then in 1966, the market started to stutter again. And this time, if you invested $1,000 at the peak of the market in 66, well, again, you would have immediately lost money, but, assuming you didn't panic, you didn't sell, you did what Wall Street wanted you to, you just hung in there. Well, this time, it only took you 16 years to get your money back, or until 1982. So 16 years until 1982 to get your $1,000 back and start making money again. 16 years. But then in 1982, the market took off. And we know what happened all the way through the 80s and 90s, right? The market just went through the roof. I mean, it went up, 15, 16-fold during that time. So we had the best bull run in history, lasted 18 years. And I don't think that we'll ever see another time period like that again, at least in our lifetimes. But that ended. Nothing good lasts forever, and nothing bad lasts forever either, but that ended. And we shifted back over into this current bear market cycle where we find ourselves now. Shifted back into the current bear market cycle, and that happened in 2000. And the question is, when does this current bear market cycle end? Because again, if we know the answer to that question, then we have a good idea what to do with our money today. But let me ask you, if you look at the last 100 years of history, are you starting to see a trend? I hope you are. And let me share with you what I see when we look at the last 100 years of history. Well, I see that there are long periods of time, usually 20 years, maybe 25 years or so on average, where the market will bounce around like a yo-yo and produce zero return. But then it's followed by a long period of time, usually 10 or 12 years or so, where the market will do really well and go up. And during these good times, when you throw in dividends, it's not uncommon for the market to have earned 15 to 20% or so. During these good times, 15 to 20%. So if you're investing over here in these good times, then you're doing really well, just like you were in the 80s and 90s. But if you're investing over here in the bad times, then how are you doing? Well, the answer is you're not doing so well, because if you're just investing in the bad times, then you're not earning anything. You're not earning anything. Now, let me ask you, if the average bear market cycle is 20 years or so, and the average bull market cycle is a dozen years or so, then the question is, how long does it take to go full cycle? Well, the answer is between 30 and 35 years, depending on which numbers you're going to add up. And isn't it true that if you want to average that 10% rate of return, that you have to be in full cycle? And the answer is yes, you have to be in full cycle. And Wall Street kind of hints at that. They kind of tell you that you have to be in the market for the long run, but the bottom line is they often forget to tell you what the definition is of the long run. Well, the definition of long run is 30 to 35 years. So if you're 20 or 30, then you can afford to be in there for the long run. But can you really afford to be in there for the long run if you're, 50 or above? And the answer is probably not. Probably not. So the bottom line is that in order to average that 10% rate of return that Wall Street touts, you have to be in the market for the long run. And that's the rest of the story. That's what they don't tell you. They don't tell you that right now we're invested in a time period that the market's going to go up and down, and there's going to be no growth. And the fact is that these time periods often last 20 or even 25 years. Now let me ask you, if these time periods last 20 or 25 years, and we're only really 15 years into this one, how much longer could we have? Well, we might have another 5 to 10 years to go. We might have another 5 to 10 years to go. And in light of the fact that we might have another 5 to 10 years to go in this current bear market cycle, and in light of the fact that the market really is at all-time highs, the next time the market makes a major move in any direction, what direction is that probably going to be? Probably going to be down. Probably going to be down. And the reality is when you look at stock market history confirms that. Because in every single one of these bear market cycles that last 20 years or more on average, every single one, there have always been, every time, at least 3 major drops. And so far in this current bear market cycle, how many major drops have we had? We've only had 2. We had a major drop in 2001. We had a major drop in 2008. We have not had that third major drop. We're waiting for that third major drop. And that makes sense because we're only 15 years into something that could last 20 or 25 years. We're only 2/3 of the way through it. So really, it all adds up. It all makes sense. Now, is it possible we're wrong? Is it possible that the market doesn't go down from here? Absolutely. I mean, no one knows in the short run what's going to happen. But the reality is do you want to bet your future? Do you want to bet your retirement on a slim possibility we're wrong? Or do you want to bet your retirement on the odds that we probably have another major correction happening? And I say you probably want to protect your money at this point. And if we are wrong, if market doesn't repeat itself this time, if market history doesn't repeat itself this time, then we would actually be breaking 3 Guinness Book of World Records that have been in force for 200 years. It would be the first time in 200 years of history that the market recovered after only 13 years. It would be the first time in market history that the market recovered without having that third major drop. And it would be the first time in market history that the market recovered without having price to earnings ratios get down into single digits. And I don't want to take time and get into price to earnings ratios. Really, price to earnings ratios measure how expensive the market is. But there's never been a recovery in 200 years of history that has occurred before price to earnings ratios have ever gotten down into single digits. And in the last 15 years, since we started this current bear market cycle, that has never happened. That has never happened. So the market would have to break 3 Guinness Book of World Records in order to not go down. And sometimes people say, well, how far does it have to go down in order to avoid breaking those Guinness Book of World Records? And the answer is about 25%. Has to go down about 25%. So I really think that 25% is another point from here that we should be looking seriously at, 25%. At this point, that puts us at about the Dow 12,000, somewhere in that range. Now, could it go down worse than that? And the answer is absolutely yes. Now, as a matter of fact, in 200 years of market history, not only have there always been 3 major crashes, but the fact is that in most of the times, the major crashes have gotten successively worse. They've gotten successively worse. So the reality is in 2001, we had a crash that was 50% or thereabouts, depending on the index that you look at. In 2008, it was 60% thereabouts. And we haven't had that third major crash. Is it possible that that third major crash is going to be greater than 60%? And the answer is absolutely. And quite frankly, I think the only reason that it hasn't crashed already, really a couple of reasons. Number one is all of the artificial manipulation that has gone on by the governments and by corporations to make our economy look better than it is. And I'm not going to take any time in this video to expand on that. We could talk about that for an hour, or you can listen to some of my past radio shows because I've talked about that on the radio. But the bottom line is our economy is propped up on a house of cards. And unfortunately, I think when the wind blows strong, that it's got a chance to fall. So that's the first reason where our economy is not really doing as well as they want you to believe. The second reason, though, is the other economies in the world are not doing well either. So it really makes us look better than we are. So if it wasn't for those two reasons, I think the market would have already crashed. And that's just important to understand. So what do? Well, the bottom line is I think you need to take a defensive posture. You realize there's no rule in the world that says that you have to own stocks. And if we think that the odds are that the stocks are going to go down, then guess what? I think we probably shouldn't own a lot of stocks at this point. Now, let me ask you, if you haven't heard this information before, you may be wondering why. Well, does your stockbroker want you to know what I just shared with you? Of course not. Does the mutual fund company want you to know what I just shared with you? Of course they don't. They don't want you to know that, the market has 20-year periods of time where it bounces up and down but doesn't produce anything. And what about the analysts on TV? Now understand, these analysts that are on TV that talk about where the market's going to go, well, guess what? Most of them work for the big firms. And what do these big firms sell? Well, they sell stocks and mutual funds. So do the analysts want you to know all this? Do they want to get on TV and share this with you? Or might they be worried about their jobs if they shared this information with you? So the reality is this is information that is brand new to a lot of you because you're not hearing it from your broker, you're not hearing it from the mutual fund companies, and you're certainly not hearing it from the analysts. So you want to be careful. Now, if you're wondering, well, how do we shore up our portfolio, or if you're a little worried about your portfolio and wondering whether or not you have too much stocks, but you don't know what else to do, well, the reality is there's a whole universe of investment options that are outside the stock market that fall somewhere between the stock market and the banks. And the reality is they're designed to protect your principal, number one, but still pay you a decent rate of return along the way. And I don't want to state the rate of return here because that changes over time, and I don't know how long it's going to be till I update this video, but a decent rate of return, at least give you a chance to stay paced with inflation. So bottom line is if you want to know whether you have too much in the market, feel free to watch our other video about the alternative investments, or better yet, call my office or look us up on the internet. The best way to get a hold of us is providencefinancialinc.com, or you can call us at 818-887-6443, and I'll be more than happy to schedule a quick call or a meeting with you in the office and analyze your situation to make sure that you're not victim to the next market crash. So thanks for watching the video. I hope it's helped, and God bless.